What's up everyone, it's Caddy with Moneyvesting. This is going to be a video on Tesla. I'll go over exactly what my plans are moving forward with this stock because it has obviously dropped quite a bit in today's market session, down almost 10%, selling off. So in this video, I want to break down what analysts have been doing, upgrading, downgrading the stock, cutting prices, raising prices, and Cathie Wood's estimate of Tesla as well by the year 2027. I'm going to break that down as well. So hope you guys enjoy this video. Find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below. If you're interested in joining us and of course getting access to all the buy and sell alerts, options alerts, trade ideas, everything is going to be included. So including the private videos and private live streams. Again, link's going to be down below with that 16% annual discount. So first things first, I already broke down Tesla's earnings in my yesterday's video, so go watch that if you haven't already. But this right here was a headline. So major analysts are cautious on Tesla now, saying the EV leader may have gone too far with price cuts. So we did get a lot of downgrades on Tesla today, like a lot of underweight rating, a lot of reduced prices on the stock itself. So JP Morgan underweight rating 115 price target down from 120. Wells Fargo equal weight rating 170 price target down from 190. Oppenheimer perform rating no price target. Deutsche Bank buy rating $200 price target, so that's good. Bank of America neutral rating, raising price target from 220 to 225. This right here, Evercore in line 165 price target. Jefferies buy rating 230. Goldman Sachs buy rating 185. We've got Bernstein underperform 150. Piper Sandler overweight 300. So you can see how there is such a dramatic difference. In other words, where the prices are. I mean, this, for example, Bernstein and Piper Sandler, there's 100% difference between the price, 150 to 300. Like, what? This is absolutely mind-blowing, right? RBC Capital Markets outperformed 212 and downgraded from 217. Citigroup, neutral rating, 175, down from 192. Morgan Stanley in line, $200 price target, down from 220. Now, remember, these price targets are for 12 months out, always. Analysts, when they put these price target out, these are 12 months out. And this right here is going to be the actual current situation with the analysts on Wall Street. 9 strong buys, 13 buys, 16 holds, 200 perform, 2 sells, with the average price right now sitting at around 190, I think it was. So 196 is going to be that number. Now, most people have probably watched this video that Elon Musk has, right, where he's explaining the pricing strategy for Tesla back in 2008. And one of the key takeaways from this video, this pretty popular video, I'm sure you watched it, is the idea that as new technology comes on board, every time we see new technology, it takes time for us to become efficient, right? For us to reduce the cost of that new technology, right? Think of cell phones, right? Cell phones back in the day used to be something that, not everyone used to have, right? It was kind of like this luxury item, right? Where you can buy a cell phone, you can have a cell phone. There were big and bulky cell phones or phones in general, where if you can buy one, that used to be a luxury. But now as the cost has come down, and of course, purchasing power is increased among people, phones are very normal, right? They're probably the most common thing everybody has with them. So that's what he's explaining in this video. And he's talking about how over time, as costs come down, as the company becomes more efficient, there's going to be price cuts, right? In other words, that's what he's kind of hinting towards, where there's going to be more mass-produced vehicles. Now, one of the things, I want to play devil's advocate here, and I want to, objectively look at that data. Now, one of the things why this is not completely usable right now is because if you think about both the prices and the cost of the technology itself, as cost is coming down because the technology is getting better and more efficient, that's great. And the prices are coming down. If they're both coming down at the same rate, margins should really not change, right? I hope that makes sense. Like, let's say, for example, that cost is $50 and price is $100, right? So your profit's $50, right? So your margin is 50%. Now, if the cost drops from 50 to 25 and you decide that you want to lower your price from 100 to 50, right? That still gives you a $25 profit, and that's still a 50% margin at lower cost and lower prices. So the margin should really not be affected if we go with the same logic as Elon Musk is using, that as cost is coming down, prices will come down. But because in this example, in the earnings that were reported yesterday, Prices came down, not the cost. That's why margins went like this, right? That's why margins compressed. That's why they went down, because prices came down, but not the cost. Maybe we see that a couple quarters from now. I want to give Tesla the benefit of the doubt, Elon Musk the benefit of the doubt that, hey, they're just getting started. They're getting more efficient now. So maybe in the future, there's going to be margin expansion again as the company starts to become more efficient, more advanced, more robotic wise. You're using a lot of technology. So it's possible that yes, in the future quarters, margins push higher. But right now, what we really saw was not what Elon Musk is explaining here, because I have seen this video sent to me a couple times, and very popular video, people talking about, hey, this is what Tesla's doing. They're doing price cuts because this is what Elon Musk said back in 2008. No, folks. I mean, this was probably on the idea of costs coming down, not prices. All right, there's a difference. Price is what's being retailed to consumer. Cost is what's costing to the company. And right now, the cost is still relatively high, and prices are the one that's coming down. That's why the margins are compressing. Something to keep in mind. Now, going over to Cathie Wood, right? Cathie Wood and ARK Invest. And before I jump into what my plan is, this is going to be their open source Tesla model that's yielding an expected value per share of $2,000. Let that sink in. That is $2,000 in 2027. The bull and the bear cases tuned up to 75th and 25th percentile Monte Carlo simulation is what they do. And that was respectively 2,500 for their bull case and bear case. Even their worst case scenario yielded $1,400. If we simply take into account the price at which Tesla's trading right now, let's just do $200 just to keep things, simple. $200 to $2,000, that's 1,000% increase for Tesla over the next 4 years. 4 years. I often wonder, what are they really, I don't want to say, but, what are they really doing? Like, what are they really smoking to get to these assumptions? But hey, she's been right on Tesla in the past. It's possible she hits it again for the second time in a row. But some of the things that they are making assumptions of: cars sold. 2022, 1.3 million. By 2027, the bear case is 10.3 million. The bull case is over 20 million vehicles. Okay. It's not impossible, but it's definitely a heck of a lot difficult. I mean, if you simply do a, very simple analysis here, what we're going to do is we're going to take into account, let's just do 2021, 2022, then we're going to do 2027. We're going to just make this over like this. And let's just do that right here, bear and bull, right? So 1.3 this year, we're expecting, let's say, let's just do 2023 here, 1.8, and bear case, they're expecting 10.3, and bull case, they're expecting 20.7. So let's just do a very simple math here. We're going to do 2027 minus 2023. So that's the next 4 years. And we're going to do 0. Present value is going to be this. Future value is going to be 10.30 and hit enter. 55%. I mean, that's actually in line with what Elon Musk has also mentioned. But if we plug in this number the same and we do this right here also, I'm just trying to get a good sense of what their compounded annual growth rate. So bull case, they're expecting the growth in deliveries to be 84% on a year-over-year basis for the next 4 years to get to 20 million. That's considering Tesla hits 1.8 million this year. And their bear case, they're expecting 54%. Even their bear case, they're expecting 54% growth on a compounded basis over the next 4 years to get to 10.3 million vehicles. Now, one thing that they are making assumption of, which I think is very true, that the average selling price is going to come down. So they are expecting the average selling price come down from $53,000 down to $34,000 in their bear case, and bull case at $26,000. So in other words, cheaper cars, more demand, more buyers, more vehicle deliveries as a result of the higher number of over 20 million. Now, it's possible, but the real question is going to be, what type of margins are we looking at? What type of earnings are we looking at in that sort of scenario where every car is selling for 26,000 on an average basis? Of course, there's going to be cars that are higher, more expensive, and cars that are lower. Now, this is a little bit of an interesting assumption, because for average to be 27,000, that means there are cars selling above 26,000. There are cars that are selling below 26,000. And I really doubt, I don't know about you, but let me know in the comment section down below, but I doubt Tesla's going to be able to come out with a car that's cheaper than $25,000 in the next 4 years is going to be a mass-produced vehicle. It's possible. We know $25,000 vehicle is out there. There's people that are expecting it. But how soon, how quickly, and how much is it going to sell, right? That's the real question. So they're definitely making that assumption as well. It's kind of baked into their average selling price and, of course, their vehicle deliveries. So revenue, they're expecting $528 billion in their bull case, bear case $346 billion, and margins, absolutely crazy, right? Absolutely mind-blowing margins at 51%. 51% margins and 52% in their bull case because they're expecting autonomous ride-hail revenue in billions, $613 billion from autonomous ride-hail. $200 billion in 2027 as their bear case, and bull case $613 billion. This happens, fantastic, but what's the probability, right? What's the likelihood of this actually happening? That's a real question. And the market cap they get down to is almost $8 trillion, $2,500, and that's going to be a 73% compounded annual growth rate for the stock from where we are right now. And in their bear case, 53% or $1,400 is going to be that price. Now, a few more things that I want to mention. This was actually quite interesting that I wanted to go over. So Cathie Wood says, based on in-depth and differentiated research, Tasha Ark, whatever those people are, just published an update to Ark's Tesla open source model. If you disagree, and here's the key takeaway from this tweet, if you disagree with any of the 40 plus assumptions, please feel free to change them and watch what happens to the price target. Here's the thing, folks. The market, the less you can assume, the better your results will be. I had to learn this the hard way, and I've had very successful investors, traders tell me that. And if you ever watched the show, I'm going to give you an example, right? If you've ever watched the show Billions, even you remember that scene when they constantly ask each other, or they ask, what was the name of the guy? God, that was I think it was Dollar Bill or something, that he was asked, what is the level of certainty, right? And he used to always respond, or there was a theme going on, that people almost always responded, I'm not uncertain, right? That's just another way of saying that I am pretty certain. So the bottom line is, the fewer assumptions that you're making, the better your results will be. Think about the 40 assumptions that somebody's making, 40 plus assumptions somebody's making on a stock. What are the chances that, the chances of at least one going wrong is incredibly high. You're not going to get all 40 right. And that's not even the point. The point is that increases your margin of error dramatically, because if you're only making one assumption, right, on a stock or a company or the forecasted future or whatever, then yes, you can either be right or wrong, right? With 40 different assumptions, your margin of error is incredibly high because they can all be widely different than what you're assuming it to be, right? It can be, with one assumption, you can at least draw probabilities that, okay, if I'm assuming this, but I've got that margin of safety, plus minus 25, 50% if it comes in here, if it comes in there, you've got all the probabilities played out. With 40 plus, the 40 plus assumption on multiple different things, chances of them coming together and hitting every single one of them is incredibly, incredibly low. Statistically speaking, it's very low. So I just wanted to point that out. But anyway, going over to Tesla now, 163 down over 9.7%. My fair value for now is still going to be at 130, but we're going to have to make some adjustments because the earnings itself are not growing. They're pretty much dropped quite a bit. So, we've got 163 divided by 350. That's the trailing 12 month. And we are now still sitting at 46 and a half times earnings for the company, which is, pretty darn high here. Now, in terms of options, if you come over to Tesla, and I'm looking at least 30 days out, so May 19th is what I would be interested in. 130 is paying you $1.11. 140 is paying you $2.30 with a really low delta. So my plan would be tomorrow to sell a cash secured put. Again, if you haven't never traded options, please make sure that you learn first before executing any of these trades. And you can also join our Discord and our Patreon to get access to all these options alerts and trade ideas and whatnot. But if you do the simple math here, 137.70, right, and divide that, so we're looking at 1.67%. or almost 1.7% return on collateral, which for 1 month or 30 days is not bad. That's pretty much in line with my personal target on a Tesla as well. So that's what we're really going to be focusing on. And yeah, that's going to be my play for tomorrow. If Tesla continues to sell off even tomorrow, then maybe I'll hold off as soon as the market opens to see if I can get better, juicier premiums for tomorrow as well. But technically speaking, support level is going to be staying put all the way down to 130. That's going to be that next level to watch. We've got a gap to fill somewhere between 140s and 150s, and a resistance staying put at 170s for Tesla as well. So let me know your thoughts down in the comment section below for Tesla. What did you make of today's price action? Are you buying, selling, holding? What are your thoughts? As always, if you enjoyed this video, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. There is a 16% annual discount again that it does expire at the end of this month. So always happy investing. I'll see you all in the next video.